Hi, I'm Pattu from freefincal. So this year, for the very first time, I rebalanced my retirement portfolio twice. In fact, this is the first year I rebalanced it once, and now I've done it twice. I did it the first time in April, and I did it in September. In fact, I've rebalanced my son's future portfolio also twice this year, and that would be the second time I have done it. In 2017, I rebalanced twice in his portfolio. So I'm just going to give you an update of where things stands for me. And this bull market has been quite a game changer for anybody who has had significant equity exposure continuously during the last 2 years. And we recently saw a reader audit on that whose net worth doubled and so on. My situation is fairly similar to that. So I had talked about how my returns dropped to all the way to 2.75% to my returns from equity mutual funds at the bottom of the crash, March 2020 crash. But then after that, it from March 2020, 2.75%, the equity mutual fund returns transformed to 13.2% in December, and then now it's about 20%. So that's the total return from 19th June 2008 to 25th September 2021. That's the first time I invested in mutual funds to now. But what is more important is the worth of the corpus, what you can do with the corpus. So we usually talk about 30x, 30x, 31x, 35x, and so on. So X means annual expenses, current annual expenses, and I have recently increased that annual expenses by 25% to just act as a buffer and to handle lifestyle changes, inflation, and so on. So this was 31x in December 2019. So 31x and X means in December 2019, if I assume a return from the retirement corpus equal to inflation, then that is zero real return. I can provide inflation protected income for about 31 years. So it was December 2019, it was 31x. It increased to 33x in March 2020 in spite of the crash because I put in some money. And with the reset value of X, currently it's about 53x after increasing the expenses and so on. So in March 2020, the equity allocation dropped to about 53-54%. And then it shot up to 63% in December 2020, and then it became 65% in April 2020. I reduced it to 60% by rebalancing once. So from April 2020 to from April 2021 to September 2021, it grew by another 5%. So I had to do a second time rebalance. I'm pushing close to 50. I'm 47, but I'm on the wrong side of the 40. So I need to build a strong debt portfolio as I hit as I approach my 50s. So that's the reason why I did the rebalance. I'm not suggesting you should do the rebalance twice. It depends on where you are, at what point of your investment journey you are there, and so on. So it's really what works for you. Now, I could have stopped investing in April 2021 and said, let me wait for the market to cool down. Then I could have avoided this rebalance. But I don't care. I'm not going to sit on the sidelines. I think it's the worst mistake anybody can ever do, waiting for the right time to invest. That's just so dumb in my opinion. I mean, obviously I paid tax for the switch in April. I have to pay tax for the switch I have paid tax for the switch in September also. But in my opinion, tax is the peanuts we toss to the government on the way to becoming a multi-crorepati. So we have to have a very long-term view of our wealth and a long-term view of what we're going to, where our corpus is going to be or where our net worth is going to be, and not worry about short-term problems like cash or tax and so on. It's just, it's not worthy of my consideration. It's just a waste of my time to think about that. So in April, what I did was I rebalanced, and then I just put that money into 3 PPF accounts. I just maxed my wife account, my account, and my son's account, 3 PPF accounts. It's a very useful feature of PPF. Most people don't do this. It's a very good way to take the gains from equity and just max the PPF for that annual year, and then the remaining I put it into ICICI Gilt Fund. In September, I had to I sold some from equity mutual funds, different funds here and there, and then I also had a old Funds India demat account. I had some stocks there, the same stocks, the Colgate, HDFC, Dabur, and one more, I think HUL. I had some stocks there. The rest of it was there in my Zerodha account. So whatever stocks was there in my Funds India account, I just sold it and just rebalanced it. Put it all into ICICI Gilt Fund. So I have explained in detail why I chose ICICI Gilt Fund. I'm completely comfortable with gilt volatility. I've had significant experience with NPS handling the gilt volatility. So I wanted a fund it's basically a dynamic bond fund, and although it will invest predominantly in gilt, and in the case of retirement, my investment tenure is open because I can continue investing in ICICI Gilt Fund even after retirement. So there's no real deadline. Although there's a deadline for my son's education, I have still used gilt, but because I'm fairly comfortable with it, I don't mind the kind of duration calls the fund takes, and I've just taken a chance with it. So it's perfectly fine. I mean, I'm comfortable with it. You have to do what's comfortable for you. That's what I keep saying. Just because I choose gilt doesn't mean it's going to work for you. You may not like it, and you may want something else. So with that, so this is where my portfolio stands. But I want to point out that, look, the only reason I do this is because I want to point out that goal-based investing is so peaceful. You don't need to worry about what the markets are doing, what experts are saying, which sector is going to outperform. You don't care. You look at your need, you look at your asset allocation, you just take the decisions. In the description, you have a link to a free seminar on how to get started on goal-based investing. You can get started with that if that's what you want to go. So this is my my pie chart that doesn't have the context which is provided in the numbers. So equity is about 59%. Out of that, mutual funds are 47%, and within that, PPFAS flexi cap is I keep saying long-term equity fund. PPFAS flexi cap is 54%. Out of that, HDFC is 27%. HDFC hybrid equity, the old HDFC balanced. Quantum long-term equity is about 18%. Direct equity is 12%. And I just recently did the stock analysis. I'm not sure if I made a video on this. Did I make a video on this? I don't know. I think I have. I still have not. Maybe I should. The debt is 40%. Out of this, NPS is 25. PPF is only 6%. It's going to mature in April next year. I'm just going to reset it back to 15. I'm just going to open a new fresh PPF account. There's no point going to these bankers every 5 years asking them to renew the account. It's just so painful. They will say after a couple of years, they will say you cannot do it anymore and so on. That's wrong. But anyway, I mean, I'm not going to waste my time with it. PPF is 6%. ICICI Gilt is 8%. Little bit of cash is there in liquid fund and arbitrage fund. That cash, I just carried it when the market crashed. I thought I just have little bit of liquidity there. I should probably build that a little more. I will try to do that. So in terms of returns, equity is 20%, NPS is 10%, direct equity is 35.3%. All of these are XIRRs, but the direct equity is about 1 year old, effectively 1 year old. So don't take that too much into don't take those numbers too seriously. That is still coming down. ICICI Gilt is just a few months old, so it's no point comparing returns about it. PPF should be about 7.5%, 7ish, whatever, some number, something close to that. You know what it is. I mean, everybody knows what it is. So that's about it. That's where it stands. It stands fairly all right. Let's see what the future holds.